In this video, I'm going to walk you through how to evaluate an industrial LP deal. So if you want to invest in real estate passively, you get a lot of these glossy documents and it's hard to tell what's a good operator and what's a scam assumption. Now, I'm going to walk through a couple of real cases, and in a second video, I'm going to talk through the legal documents, the operative stuff, so you know what to look for or what to ask your lawyer if you want somebody to review this. We're going to be looking at this Atlanta Industrial Portfolio number 1. It's on market, Class B, light industrial, multi-tenant, pretty standard offering, okay? 211,000 square feet. You've got 9 buildings, 81% occupancy, which is good, right? I think something in the 60 to 80% range shows value add to increase occupancy, but it's not so low that there's a lot of risk on the capital side. So you've got a map, you've got their locations, airport proximity. I don't know how much that helps, yay or nay, if they're related to that. 22 million purchase price, 26 million including some capex. Again, they've got all these numbers here: 18% IRR, almost a 2% equity multiple, a 2x equity multiple, pretty low cash yield. Again, this is a little bit older. Reasons to acquire, replacement costs. I get it. All of these things are good, but I kind of treat them as a minimum. All properties should have some type of base case where there's 3 or 4 items that are good. If you don't have those, you can't tell the story. It really just depends on the numbers of what their return assumptions. So this is a slide that people talk about a lot. I really don't even care about this slide. You can manipulate almost all of these numbers, tweaking plus or minus 20% to hit these numbers. What is important is the assumptions and the execution of the local market that drive everything. I'm going to trust my operator to do a good job, but if their assumptions are completely in bozo land, it's not going to matter. All right, so cash flow from complicated, okay? Whenever I see complicated waterfalls, I don't think that it's necessary. I don't think it's necessary to align risk because I want to put my money with operators who are willing to give more upside to LPs to keep us happy, to keep us coming back for more. When you have complicated waterfalls, they have crafted these waterfalls to align their incentives to hit their waterfall and generate the highest return for them, not necessarily doing you a favor. And I want to invest with people that are going to move heaven and earth to make sure this deal doesn't lose money versus trying to invest with somebody that has complicated waterfalls. So that's it for this. Again, there's some capex, there's some closing costs, 600 grand, 1.6 million in improvements. I get it. I think it's all good, but they don't really tell you what these assumptions are. Refinance, a disposition. So the disposition, I think, is probably going to the GP. We want to look in the legal docs for what does it say about acceptable fees that the sponsor or general partner is allowed to charge. Loan terms. All right, this is a couple years ago, but it's super good to see, 100% of all bank debt, 2.7 equity, DSCR, tenant mix, heavy auto, okay? That triggers a little bit, not a red flag, but I want to be aware. Auto users are tough, okay? They have tons of parking requirements. They look ugly. They're parking broken cars, either physically damaged or leaking oil or in a crash, collision cars. Paint smells, petroleum products, lubricants, they're just a mess all over. And so auto tends to piss off every other single user that's sharing a common space in, say it with me, multi-tenant industrial, shallow bay. In-place leases, $9 a foot. WALT is okay. Again, for a 5-year hold, a WALT of 2 is great. Again, more assumptions here. What I would say you do is you got to go into that market and you got to confirm some of these numbers. Don't just take what they say for granted. I don't know Atlanta. I can't really opine on whether these assumptions are good. But if you're going to be investing in a specific market and or asset class, you've got to become an expert on what assumptions are valid. So they've got some comps, undisclosed term, have a rent. It's a little bit troublesome that they don't have an idea on term, because a high PSF might make sense for a 1-year term. It's 1,000 square feet, so it's super small. I wouldn't really even use that as a comp unless their average square footage was also starting with a 1. But 1,000 square feet is tiny. I think $13 a foot is probably a much better comp given the size of the spaces, somewhere between $13.50. But this $2,000 at $12 is not great. I'd want to look at that building and go into Google Maps and look at the condition of that Lakewood Ave. Risks. I find it very concerning. The risks section is the shortest paragraph of this entire offering memorandum. We've got 30 pages of offering memorandum here, and the risks talk for a 3 to 6 month downtime, no recoveries, inability to achieve rental rates, and that's it. They have 2 issues as risk factors. I think that's woefully insufficient when it really doesn't talk about the macroeconomics. Does it talk about new supply? Does it talk about CO or zoning? Does it talk about, if you don't hit your lease rates, what happens to the cash flow? What happens to the return? It's very short when I think they know what could happen, but they don't say it to the investors, and that's concerning. Comps on sale price, again, it's per square foot is useful, but I would really want to try to back into a NOI or a cap rate comparison, because a cap rate is going to be more accurate based on what your NOI is versus just a PSF. I mean, it makes sense for Peachtree to sell for a lower price per foot if they don't have the income. They might have identical cap rates, but Oak Brook has higher net income. Of course, it's going to sell for more money. Again, both objectively similar sizes, but if it just has lower income, it's an older building. Again, it's not a useful comp to me. I want to look at NOI, cap rates, and then age of building. Again, got a nice pro forma. Everybody can put these numbers in. This one is a little bit more current. We have this Stoic Equity Partners. They have a 30-page. They have a table of contents on this one. Fund details, a little bit more recent. I guess this one's still active, ongoing. Value add flex, very similar asset type, similar location as well in the southeastern asset strategy. Removes the amount of office. Man, this stuff is expensive. Renovating the suites to warehouse. Okay, curious abbreviation there. Seems like they have enough space, but maybe not. Improved exteriors, new roofs, paintings, landscaping. I mean, this is a lot of work. I would not consider new roofs as cosmetic, and I would not consider demising office just as cosmetic. You're getting to some serious structural potential concerns, and these are big projects that cost a lot of money and take a long time. And the longer a project goes on for, the higher risk to the investor. Class B industrial, I get it. Everybody knows the story. It's a popular product. It really comes down to what's the price you're paying for your stuff and what are your assumptions to hit your returns. Target market, I don't like this description. SEC region, Texas, Louisiana. I would not invest in Mississippi and Alabama, some of the poorest regions of the entire United States, just because they're part of a football conference. That isn't the factor for me. Maybe I like Georgia, maybe I like Florida, maybe I like Tennessee and Texas. That doesn't mean I like Mississippi equally, and I think they need to be a little bit more refined on that. Minimum amount $3 million, debt partners. Again, this is all useful, nice to see. IRR minimum 5, so they're a little bit lower, right? Yields have come down on commercial real estate. Sellers are getting more for their property. Migration maps, we know it, but it's not evenly distributed throughout these states. I would not touch this whole area. This whole area is very poor, not a lot of growth. Northwest Arkansas, you're good. Tennessee, Carolinas, you're good. Florida, you're good. Texas is thumbs up. All right, so they spend a lot on that. 506C. I like these guys. Okay, here's a point for them. They do disclose a lot more of their fees here, asset management, dispo, and they have a simpler waterfall, which again, these are newer guys. They're not as established with a track record. So I do think that they are trying to give more money to their investors to prove themselves, so you'll give money in the future. Timeline, again, these are some assumptions. It looks not very detailed, but I suppose they're closing on assets between now and 2028 as well. They have this Louisville, Kentucky. I like Kentucky. Seems good. 13 closing costs, capital costs. So capex is relatively light. They have a lot of reserves for higher interest costs. Total use. They have low leverage. That's a big part of it. Low leverage, reduced loan amount, pref equity and fund equity. Sponsors putting in not a lot. I mean, on a $14 million project, they're putting in 1%, which is fine, but it's not a lot of money. It's not enough of a cushion if I was going to invest. So 14% IRR, 1.5. Is this attractive, guys? I mean, I really think there's more deals out there that you can buy yourself to hit these kinds of okay returns. This is good if you're deploying 400 million. If it's less than that, I don't know, buy your own deal. 15% and a 1.6. And again, this is their rosy example. This is the best case scenario. I don't know that they're overselling, but I like the range on the prior OM. But this is 1.6. They're putting that number out there. We'd love to hit 1.6 equity multiple. We did what we said. It's not a great return, and if they hit something much lower, it's just getting your money back plus cash flow. And cash flow for a development type risk of deal is not good. For this type of longer development, you need to have a higher lift to be compensated for the return, compensated for the risk. Another property in Mississippi. Again, I kind of ragged on Mississippi, but look, I mean, the returns are low too, 13 and a 1.7. So that means they're banking a lot on the exit. When you see a low IRR, it's either a long-term hold, more work, upscale office, 158, 10-year tenant tenure. I mean, that's good, but sometimes those tenants are only staying because the rents are cheap. Fund acquisition. So again, these are getting a little bit better, but they're also smaller deals, which again lends itself to higher returns on smaller deals. But if you're watching this video, you could probably take down this asset yourself. It's a $5 million multi-tenant flex. That's an easy lift for more individual investors. It's not like a $20 million deal that's hard to raise equity. Again, they go into the market. We go into a lot of these things. We look at their current assets. I like this. I mean, I think this shows me of their local expertise. And, I would want to be buying stuff where they know the local market really well. So they've got a fair number of assets here in southern Alabama, Little Rock, one in Florida, but that's Pensacola. That's very close to Fairhope. Even this Georgia asset. So yeah, a little bit about them, their focus, their philosophy. I think that's great. They manage 13 million, small in terms of the overall shop, but these might be guys that are trying to make a name for themselves. They do have a team. They do this full time. It looks like they're inspired by stoicism and that philosophy. So I think they get a point from me for the stoicism. Thanks for watching. I hope this helps you kind of get a feel of what I look for. A lot of this is fluff, but stay tuned for the next video, and I'm going to talk about the operative legal documents and what you should be looking for to make sure that the legal docs actually reflect what you think you're being sold. So have a Merry Christmas and Happy Holidays. Ho, ho, ho from this lawyer in Dallas, Texas, and we'll see you next time.